Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Higher for longer. That is the message from the Fed after the central bank holds rates for a sixth time in a row. Fed Chair Jerome Powell keeps cuts on the table, but the timing is less than certain.
I do think it's clear that that policy is restrictive. I think it's unlikely that the next policy rate move will be a hike.
Most stocks in Asia rise after the Fed stands pat. The yen whipsaws, though, tumbling in the session, pairing a rapid 3% rally on suspected intervention. Plus, another big day for earnings in Europe. Standard Chartered reports a pre-tax profit beat. Both Shell and Novo Nordisk are also due to report. But first, ING, and this is the red head. The analysts have been scrutinising the details around the buyback, and this is the news coming through from ING. The Dutch lender coming through with another €2.5 billion share buyback, following on from their previous €2.5 billion share buyback. So another share buyback rewarding investors with additional cash coming through from ING. In terms of net interest income, this was also being scrutinised by the analysts as well, coming in essentially in line with the estimates, bang in line with the estimates at €3.83 billion. That is NII, net interest income. In terms of net income for the first quarter, it was a beat for ING, the lender coming through with net income of €1.6 billion, just shy of €1.6 billion, above the estimates of €1.45 billion. ING saying it's added, by the way, 99,000 primary customers in the quarter. But the key line is the buyback of €2.5 billion. I'm going to be speaking, by the way, to the CFO of ING in the next 15 minutes or so. That interview at 6:15 a.m. So stay with us for the lines from the CFO and the reaction to the details and earnings coming through from that Dutch lender. Let's check in on these markets right now. Of course, digesting what we heard from Jay Powell and the Fed. No surprise that they held, of course, at around 5.25%. But it was the language from Jay Powell pushing back on the views from some. An outlier view that maybe hikes were in the card. He pushed back on that and says that cuts are still possible this year. But again, the timing is uncertain. European stock futures then currently lower by 0.2%. FTSE 100 futures pointing to additional gains of 31%. 31 points, I should say, up 0.4%. S&P futures looking to add 0.5%, and after ending down in the session yesterday. And Nasdaq futures looking to gain around 115 points, putting higher by 0.7%. Of course, the earnings story important in the US as well, with Apple crossing with their earnings later today. Cross asset 494 currently on the 2-year. You did see a move lower in yields yesterday on the back of the commentary from Jay Powell, back below 5% at the front end. The yen, of course, whipsawing. We'll get the details on that story. 155 on the yen right now, down 0.8% again after the rally that we saw yesterday. $83 a barrel, just below 84 on Brent, up 0.6%. Gold holding firm on expectations that a cut is still possible from this Federal Reserve, 2,318 per troy ounce on gold. There's some more breaking lines coming through from ArcelorMittal in terms of EBITDA for the first quarter, coming through with a decent beat then, $1.96 billion. close to $2 billion in the first quarter for ArcelorMittal, above the estimates of $1.71 billion. It's a beat coming through from that company as well. Bringing more details as we get it. Let's cross over to Singapore, where Avril Hong is standing by with a check on the Asian markets. Avril.
Yeah, Tom, we're seeing a mixed bag in stock markets in the region. The Fed not giving much to the Japanese or the South Korean stock market investors. Where we are seeing a rally is in the Hang Seng, that is on track for its 8th session of gains. This would be its longest winning streak since 2018. And this is pretty impressive considering how it's doing this in the absence of a crucial pillar of support for its world-beating rally, mainland investors, because China is, as you know, shut. A lot of bottom fishing has been going on. Chinese stocks have become too cheap to ignore. But let's flip the board and take a look at the sectors that are responsible for a large part of this. It is the Chinese tech names, your Meituans, your Tencents, that are due to report or expected to in the middle of the month. And the idea here, I think, is partially to do with how their U.S. counterparts have been faring pretty well this earnings season. And maybe the Chinese names can do similar. Now, we're also keeping a close watch on the real estate developers listed in Hong Kong. Kong, sentiment towards them seems to be turning. We did get Beijing loosening some of those home buying restrictions, and the idea potentially coming through here from Bloomberg Intelligence that we could see similar moves in major cities in China. But let's take a look here at what we're seeing in the currency space, because that is where we're seeing more of the relief, the reprieve coming through. The Korean won, Thai baht, Philippine peso, they're all gaining ground against the greenback, perhaps bracing for that more hawkish Fed, which we didn't quite get. Let's flip the board, because the currency that didn't benefit, I think, as you know, Tom, is that of the Japanese yen. And this is a currency that hit 1.575 and then was quickly brought back to 1.53. And this smelled a lot like intervention. We've seen 3 such sharp moves this week. The yen bears are back for now, with the yen pushing towards the 156 handle. They have the fundamentals on their side, I have to say, as it's really been about the yield gap, especially after the FOMC today, Tom.
Abraham, thank you very much indeed. We'll stay on the implications, of course, the FOMC decision. Fed Chair Jerome Powell keeping hopes alive then for a rate cut this year. But he also says a burst of inflation has reduced confidence that price pressures are ebbing.
We do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected.
OK, let's bring in Bloomberg M-Line's Mark Cranfield for the analysis then. Mark, if this was a hawkish pivot from Jay Powell, it was the dovish end of the spectrum, it seems. Is this a Fed with an easing bias?
Certainly Mr. Powell, I think, would very much like to lower interest rates. If you think back to December, he was the one that really kicked off the idea there could be several rate cuts this year. He was excited that inflation was coming down towards his target. And of course, there was at one point, there was data which was showing that on an annualized basis, we had one of the key readings at 1.9% below his key 2% threshold. A lot has happened since then. As we know, there's been several CPI prints that have been higher than expected, a lot of backtracking, also some strong jobs numbers. And here we are, we come to the situation in May where really it's very difficult to see that they could even manage one rate cut, but at least he's keeping the door open for that later in the year. More importantly, in this specific meeting, what he had to say about quantitative tightening was much more helpful. And that was the slight surprise of all the things that happened here. He gave some hope to the bond market, especially, which in turn gives a little bit to the equity market by reducing that quantitative tightening quite substantially, more so than people expected and at a quicker pace. It's going to start from June. Some people thought it would only happen around the third quarter of the year. So he's going to reduce it by more than half. That takes a lot of pressure off the bond market. If treasuries are in a better state of health, it means that the upward pressure on yields will probably ease slightly. Doesn't mean to say that yields are going to start tumbling by any means. But the fact that there'll be a more stable situation, equity people can look at that with some hope. And then you can look at the foreign exchange market as well, but it will take away a little bit of the pressure, particularly on dollar yen, which obviously we've been talking about a lot recently.
Really, really interesting. Really glad you zeroed in on the QT lines, of course, reducing that cap, as you say, and less issuance, less bond issuance for this bond market to have to digest, and how that impacts equities and, of course, flowing over to the yen as well. Mark, when it comes to what to watch for next then, we get the jobs data on Friday. There's a view from some being articulated yesterday. If you get a solid number above 4% on unemployment, that could push this easing bias, if that is one for the Fed, even further in that direction. In terms of the jobs data, how consequential could it be in terms of changing the views on this Fed come Friday?
I think they're always important. Jobs numbers definitely is one of the big ones. But when you think it's plus or minus 4%, in the grand scheme of things, that's a very strong employment situation. There's not much the Fed can do with that. Really, it's all kinds of inflation impacts which are much more important to their calculations. And just this week, we saw that some of the earnings numbers were a bit on the higher side as well. So clearly, if workers are getting more money than expected, that'll feed back into the economy as well. So for now, it's really all about inflation impacts as far as they're concerned. And until they see a significant improvement, and now the the onus is very much, it hasn't just got to improve, it's got to improve materially, because there have been so many numbers which were higher than expected. So they're really back almost to square one, really. They've got to see a few months of consecutive CPI decreases, and then they can start talking about rate cuts again.
OK, Bloomberg MLive's Mark Cranfield with the analysis on what we've been hearing from Jay Powell and the Fed. Thank you very much indeed. From the macro to the corporate-facing stories now. And Apple's results, of course, coming in after the US market close today. Revenue expected to contract as the tech giant faces a continued slowdown amid a weak Chinese market, regulatory pressures and AI strategy concerns. Let's cross over to Bloomberg's executive editor for Asia Technology, Peter Elstrom. And Peter, what can we expect from the numbers today? How much of this is going to be a China story for Apple?
Yeah, all eyes are on Apple at the moment, trying to figure out exactly how the company is navigating some of these resistant forces ahead of it at this point. It's an unusual place for Apple. I mean, they've had such an amazing run over the past few years, but now they're struggling. We could see revenue decline yet again this quarter. The expectations are that revenue will be down about 5%. A lot of that is because of the smartphone market, and as you alluded to, China in particular has been a challenging market for them. iPhones, of course, have been the big driver of growth at Apple for many years. In China right now, they're facing some headwinds because of the resurgence of Huawei in particular, but also Xiaomi, another company in the market. So we've seen them lose quite a bit of ground within China to those two companies, especially Huawei, as it's now gotten back into the smartphone market after the U.S. blacklisting that caused some problems for them. Now there's a lot of nationalistic-driven demand for Huawei phones and for Xiaomi phones in particular. One of the things for Apple, though, is that they're struggling within China. They're trying to figure out how they can revive demand there. They've discounted a little bit. They're opening up some new stores, too. But it's still been a challenge for them. And we'll see whether they're able to talk about the future and their prospects for reviving. Another couple of key things that people will focus in on are the Vision Pro, this headset that they introduced with much fanfare. They view that as one of their big long-term bets. They hope that that will show some promising results. And also, they want to hear about Apple's AI strategy. We have not heard as much from them as we have from, say, Microsoft or Google at this point. People really want to understand how Apple is going to integrate AI into their products in the future.
Peter, on that, just putting a pin in the AI component, because I think that's really important. A couple of the analyst notes pointing that out, the lack of clarity on that front in terms of that strategy, as you say. Are we expecting details today on the back of the earnings call, or do we have to wait for one of their big conferences, one of their big events, for the details to come through? Where do we stand on this AI strategy?
Well, they certainly will get questions about AI. You're right. Other companies have done more to articulate exactly what their strategy is going to be. Microsoft perhaps has been most aggressive. The CEO of Microsoft, Satya Nadella, is in Asia right now explaining how much they're going to invest in AI data centers around the world, particularly big countries like Indonesia, India, Malaysia, and Japan in particular. Apple has not really gone down that road so far. They'll get questions about their AI strategy, but what you're alluding to is exactly right. They tend to want to have these big events where they can have a complete, well thought out, very detailed strategy as they introduce it. We haven't seen that from Apple yet with AI. Certainly they are working on this. They're working with they're probably talking with many different partners at this point to try to figure out exactly how they're going to incorporate AI into their products in the future, their services in the future. So certainly Tim Cook will get a lot of questions about AI at this call.
OK, Peter Elstrom, Bloomberg's executive editor for Asia Technology, setting us up really nicely for those important Apple earnings. Peter, thank you. To the banking space now, we're going to get more details and an interview with the CFO of ING after that company announces a €2.5 billion share buyback, being joined by the CFO of the Dutch bank to talk about those earnings. That interview in just under 10 minutes. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Bloomberg has learned the US and Saudi Arabia are closing in on an historic pact offering the kingdom security guarantees and a path to diplomatic ties with Israel. Sources say officials are optimistic a deal can be reached within weeks, although obstacles remain. Israel is expected to be offered a choice to join the deal, dependent on ending the Gaza war and agreeing to a path towards Palestinian statehood. New York police have arrested almost 300 people, breaking up escalating protests over the Israel-Hamas war at 2 colleges. The arrests were made at Columbia University and City College of New York. Police officials say outside agitators joined the Columbia protest, but are still determining how many non-students were arrested. Alphabet paid Apple $20 billion in 2022 for Google to be the default search engine in the Safari web browser. The level of the payments were revealed in newly unsealed court documents in the US Justice Department's antitrust lawsuit against Google. The deal between the tech giants is at the heart of the landmark case, which alleges Google has illegally monopolized the market for online search and related advertising. Qualcomm shares rose after the world's biggest seller of smartphone processors gave an upbeat forecast for sales and profit. The outlook signals the smartphone market has begun to bounce back, tracking with Qualcomm's forecast that demand would gradually recover this year. The US company also reported better than predicted results for the second quarter. Coming up, ING announcing a €2.5 billion share buyback. I'm going to be joined by the CFO of the Dutch bank to talk earnings. That conversation is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, ING has reported first quarter profit beating estimates. The biggest bank in the Netherlands has also announced a €2.5 billion share buyback. Very pleased to say I'm joined now from Amsterdam by the CFO, the Chief Financial Officer of ING, Tanate Phutrakul. Tanate, thank you for your time this morning. Let's start with the buyback then, €2.5 billion. What does it tell us about your ambitions around returning cash to shareholders? Are we at a peak now in terms of buybacks?
Thank you, Tom. I think we had a really strong start to 2024. We continue to accumulate customer. Loan growth is strong. Deposit growth is strong. What particularly marked this quarter is our fee generation, which has been exceptionally strong this quarter. Costs are on track. Risk cost remains benign, below our through the cycle average. And that capital generation has allowed us to do this €2.5 billion share buyback. And to address your question, we have targeted that we would reduce the level of capital that we operate at from our current 14.5% or 14.8% to around 12.5%. So we are trying to make that conversion through share buybacks and other cash distribution over the next 2 years. So, this is part of our plan to kind of return capital or return cash to our shareholders in a step-by-step function.
OK, so to be clear, we're not at peak buyback yet for the business as we weigh up, for example, interest rate cuts from the ECB.
Well, what I can say is that we look at many factors in terms of determining the size of our share buyback, capital generation, the level of risk that we see, the stresses that we see, and also the commitment remains that we would look to bring our capital levels down to 12.5 over the coming period, and we stick to that.
OK, talk to us about, I want to get on to fees, but before we get there, net interest income, are we at a peak kind of level when it comes to NII, given expectations that rates will be coming down likely in June from the ECB?
Yeah, I think that's one of the big drivers of results for European banks and including ING. I was looking at the Fed chairman's discussion this morning about Federal Reserve maybe delaying rate cuts. That would have a read across to the ECB decision making. So the market expectation is that June will be the first rate cut. But I think the shape of that rate cut will be more benign than perhaps even the market expect. And with that in mind, what I want to say is that we believe we can operate profitably and in a structural way when rates are at 4%. And we expect that we can operate quite profitably, even if rates comes down to 2.5 to 75. So I think we're quite optimistic and bullish about the resilience of our interest income.
And you talked about the strength of the fee income as well. What is your outlook for that? How does that story evolve, do you think, in the quarters ahead?
Yes, one of the main strategy for ING is to become less interest rate driven, more capital light as a business model. So we target fee income growth around 5 to 10%. And what we see now is that the first quarter we grew fees by 12%. So it gives us a good base to make sure that we stay within that 5 to 10% outlook. And we are confident of reaching that levels in 2024.
What is demand for mortgages and corporate loans looking like, and what it tells us about the strength of the Dutch, of the Eurozone economy?
Yeah, I think particularly on mortgages, we do see volumes picking up. You see this big shock with rates going up, that mortgage demand has declined for a number of quarters. But the resumption of lending growth and the deal in the pipeline is getting stronger. Margins are improving, so origination margin is beginning to improve from a low in 2023. And I think in the wholesale bank, we also see the same phenomena with deal in pipeline building up strongly. So we're quite optimistic about resumption of loan growth on the back of potentially lower interest rates in the coming period.
Any concerns at all about credit quality? Are you seeing any examples of that deteriorating?
Not yet. I think we see our stage 3 ratios at 1.5%, historic low. Our risk cost this quarter remains benign, very much below our through the cycle average. So I think this is a credit to the resilience of our customer base and a resilience to the euro economy as a whole, that the situation remains quite resilient and solid, with, I think, driven to a certain degree by quite tight labor market and low unemployment. So I think we're optimistic about the condition of our credit book.
Tanate, I want to ask you about your exposure to Russia, because early on in the conflict, ING said that you would wind down the operations there at a speed and pace that was aligned with the interests of shareholders and your customers. Are you under pressure at all from regulators, from the ECB primarily, to speed up that rundown?
Yeah. We have 3 points we want to make here. We have no future in Russia. It's been made clear that's what is our intention. We have reduced our exposure to Russia from the peak at the beginning of the war by over 75%. And we will continue to de-risk and also have an orderly way to bring the level of exposure to Russia down. We have constructive dialogue with our regulators on this point, and we are progressing at pace in terms of de-risking from our exposure to Russia.
OK, before we let you go, return on equity, the goal, the target of 12% through 2026. What's your level of confidence that you hit that target?
High.
That's it, high. OK, you're going to hit that target. 2026, return on equity, 12%. OK,
I think we have an investor day coming up in June 17th, and we'll give a longer outlook around our return on equity targets then.
OK, we're going to take that confidence, though. Tanate Phutrakul, thank you very much indeed for your time, of course, on the back of those earnings. A beat coming through for ING, the CFO there of the business, of the Dutch lender, coming through, of course, with the buyback as well, an additional €2.5 billion. Quickly checking in on Standard Chartered, because that bank also came through with a decent beat across most metrics. The wealth business doing really well, trading also picking up for this company. The lender, of course, with exposure to Asia, gaining 5%. In the Hong Kong session so far. We'll watch that at the open in the UK as well at 8 a.m. So Standard Chartered, a beat, stocks rising. Plenty more coming up. This is Bloomberg. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Higher for longer. That is the message from the Fed. After the central bank holds rates for a 6th time in a row, Fed Chair Jerome Powell keeps cuts on the table, but the timing is less certain.
I do think it's clear that that policy is restrictive. I think it's unlikely that the next policy rate move will be a hike.
Most stocks in Asia rise after the Fed stands pat. The yen whipsaws, tumbling in the session, pairing a rapid 3% rally on suspected intervention. Plus, ING announces a €2.5 billion share buyback after the Dutch bank tops profit estimates in the first quarter. Standard Chartered also rising in Hong Kong after its own profit beat. Here, though, is the biggest European company by market cap, Novo Nordisk, coming through with results. Novo quadrupling the number of patients starting on Wegovy in the US. Quadrupling the number of patients starting on that weight loss drug in the US. We knew there was scrutiny from analysts on that, particularly around supply chains. Novo sees full-year sales at a constant FX up 19 to 27%, higher than the estimates at the top end. The estimates had seen full-year sales at around 26%. At the top end now, Novo guiding for up to 27% in terms of full-year sales at constant FX. Other lines coming through in terms of sales and in terms of the particular makeup of the portfolio, of course, of drugs. First quarter Ozempic sales coming in above the estimates, 27, close to 28 billion Danish kroner. That was above the estimates. Looking for further details on supply chains as well and the investment around Wegovy. But the top line is that they are boosting, quadrupling again, the pickup in terms of Wegovy in the US. First quarter obesity care sales coming in slightly below the estimates, 11 billion Danish kroner. The estimates have been for 12.3 billion. And in terms of GLP-1 sales, those coming in modestly above the estimates. Wegovy sales, this is important, slightly below the estimates, in fact, in the first quarter. Wegovy sales coming in at 9.38 billion, below the estimates of 10.5. Whether this is a supply question versus demand is going to be interesting. More likely, it's a supply question. We know they've been building out capacity. Again, in terms of margin for the first quarter, Novo Nordisk coming in with margin just above the estimates. 84.8% is the margin, slightly above the estimates. Novo saying that US demand for Wegovy still exceeds supply. The demand still exceeds supply for Wegovy, the weight loss drug, in the US. Again, they have quadrupled the number of patients starting on that drug in that crucial US market, keeping their full-year sales in terms of the expectation, raising the bar slightly, 27% above the estimates. This is a story, of course, we will keep for you throughout the next hour. We're going to be speaking as well to the CFO of Novo Nordisk, speaking to Bloomberg later this morning. That interview, 9:05 a.m. UK time on the Pulse. First quarter pre-tax profit coming in above the estimates, 32 billion Danish kroner, above the estimates of just shy of 30 billion. Let's check in on these markets right now. Earnings is part of the mix, absolutely. The beats coming through from the European lenders, Standard Chartered, with the, of course, exposure to Asia, but also ING and the buyback there. But we can continue, of course, to weigh up what we've been hearing from the Fed, pushing back on the view from some that maybe an additional hike is needed. Jay Powell pushing back on that. Cuts are still possible this year, but this is a patient Fed higher for longer. European stocks pointing lower by about 0.1%. UK futures, FTSE 100 futures looking to add 36 points. S&P futures currently looking to add 25 points, up 0.5% after ending the session lower yesterday. And Nasdaq futures pointed to gains of 0.6%. Let's flip the board and look cross-asset. Then the yen again, the volatility there. And we use the word whipsaw, and accurately so, because it has been dramatic, the moves once again. Expectations that the BOJ, the Ministry of Finance, I should say, intervened again. We have not, of course, had concrete confirmation of that. 155 currently on the Japanese yen, down 0.7% after it popped 3% yesterday. The two-year back below 5%, 4.94 yields came down on the back of the presser yesterday from Jay Powell. Brent, $84 a barrel, just shy of that, up 0.6%. And gold, 2,314 per troy ounce. Just a little softer now for the yellow metal, down 0.2%. Now to geopolitics and the Middle East. Bloomberg learning that the US and Saudi Arabia are nearing an historic deal that could potentially reshape security in the Middle East. Let's get the details from our senior editor, Bill Ferries. Bill, what do we know then about the potential details of what could be a really consequential deal?
Right, Tom. Well, this is a deal that was being discussed last year ahead of the outbreak of violence in October between Israel and Hamas. Those talks have resumed in recent weeks and seem to be accelerating. There's a lot of different components to it. One big part of it would be getting Saudi Arabia and Israel on the path toward basically having diplomatic relations, a normalization of ties. That would require a quick end to this war in Gaza, and it would also require Prime Minister Benjamin Netanyahu to agree on a pathway to Palestinian statehood. That's something that he and his coalition have been very much against since he returned to power. There would also be a lot for the Saudi Arabia and the U.S. in this kind of an agreement. It would effectively give Saudi Arabia a U.S. security guarantee. That kind of an agreement might require U.S. Senate approval. But in return, Saudi Arabia may also get access to some high-tech weaponry that it doesn't currently have. Saudi Arabia could also be allowed to pursue a civilian nuclear program, and that would give the U.S. access to Saudi uranium stockpiles. So there are a lot of potential wins for both sides here, but it is very much hanging on some other issues that are going to be difficult to resolve.
So, Bill, what are those issues? What are the hurdles that could get in the way of this deal?
Well, if Israel wants to be a part of this agreement, and for Netanyahu, getting a deal with Saudi Arabia has long been one of his goals, but it would conflict with another one of his political priorities now, which is basically avoiding having to accept a two-state solution to the Palestinian crisis. So he would have to decide which of those two goals is really politically more important to him right now. It could mean the end of his coalition government. There would be a lot of complications with that, obviously. And also, the biggest hurdle would be winding down this conflict in Gaza. And, we've seen with Israeli troops poised to enter Rafah for weeks now, that there does not appear to be a solution in sight. There is talk about a six-week-long ceasefire, but that's also been something that's been going on for a while. So a lot of hurdles, but talks are advancing, I think, on the Saudi and U.S. sides in the hope that some progress can get made.
OK, senior editor Bill Ferries on the potential consequences of what could be a seismic deal for that region. Bill, thank you very much indeed. Let's stay with the region then and check in on oil because, of course, part of the mix in terms of the movements we've seen over the last few days has been quite pronounced around oil, the softness that's come through. That's turned around a little bit today, but part of the focus had been on those talks around a potential ceasefire in Gaza, but also the inventory build-up and the stockpile build-up in the US as well. And that data had pressured the oil price in the last few days. Today, pairing some of the losses to some extent. 0.6% is the gain that's coming through for Brent. $83 a barrel, just shy of 84. $79 a barrel, still below that 80 level for WTI, up 0.6%. Let's go to one of the biggest corporate stories at the moment, though, before we get those Apple earnings. Of course, it's Novo Nordisk, the biggest European company by market cap, coming through then with the details on its earnings, raising the guidance in terms of the full-year sales picture and giving some detail around the uptake and the demand for its key weight loss and obesity drugs in the US. They are looking to more than quadruple. In fact, they have more than quadrupled the number of patients starting on Wegovy in the US. Let's get more details there, more analysis, and bring in Bloomberg's Sana Vess in Copenhagen. Sana, give us the top lines then. What's driving Novo's results at this point?
That's what you wanted to hear, right?
Yes, Novo profits are up were up once again last quarter, and it is very much driven by sales of its two drugs, Ozempic, and its blockbuster drugs, really, Ozempic and Wegovy. These two drugs are very popular among patients because they have helped people lose weight. Demand is extremely high, so high that Novo simply can't keep up. Novo today is saying that demand is still exceeding supply. So Novo's really selling everything it can make, and it's trying hard to make more. And that's really something that investors are following. And Novo has a first mover advantage, but it will only really be able to capitalize on that if it is able to also ramp up supply.
Well, that is a key question, as you say. So what progress has been made then by the company to work through some of those supply issues? How is that going?
Yeah, well, there is some progress. We've seen Novo has released figures today saying that now 20,000 patients start on Wegovy every single week in the US. That number was 5,000 back in December. So we are seeing kind of an increase in the number of patients that can start on its drugs. And then, of course, we've also seen a lot of announcements of investments into expanding its factories. and also to buy new manufacturing facilities in the US. But of course, those investments are taking a bit of time to translate into also bigger supply.
OK, Sanne Vest, thank you very much indeed. Jumping on those earnings for us around Novo Nordisk, of course, really consequential given the size and the market cap of that company. We'll keep across that story throughout the next few hours and, of course, be speaking to the CFO as well at 9:05. Sanne Vest, thank you very much indeed out of Copenhagen. Now, we will be speaking, as I said, to the Chief Financial Officer of that company, 9:05, on The Pulse. Coming up, China's top climate envoy warns the West, that decoupling from Beijing could cost the global economy trillions of dollars. More from our exclusive interview with Liu Zhenmin. That is up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Thursday. Now, the Fed has signalled fresh concerns about inflation, but Chair Jerome Powell reassured investors a rate hike is unlikely. Let's get some analysis then from Nina Skero, CEO of the Centre for Economics and Business Research. Nina, thank you for joining us. Let's start with the top line then. How what you heard from Jay Powell, what you saw from the statement, changes your view in terms of the policy response from the Fed in the months and quarters ahead?
We're actually going to stick with our prediction that the first cut from the Fed is coming in September, and that is something we were expecting before yesterday's minutes and yesterday's press conference as well. We were never, certainly not under our central forecast, expecting a rate hike, but if there was one surprise from yesterday's events, it's how firmly Powell, I would say, put those guesses to bed. You know, the message was very much the bar would be very, very, very high for the Fed to do another hike. And I would have been expecting messaging to be a little bit softer around, you know, we will be data dependent. We will see the path of inflation progress towards 2% target has stalled. So I was a little bit surprised by the tone of his messaging, but we're sticking with our expectations that there will be a cut coming in September.
Nina, we've been getting some reaction from other guests as well, and from Jay Powell himself. Let's listen in to the Fed chair, and then I'll bring you back in for your analysis.
In recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. It is likely that gaining such greater confidence will take longer than previously expected. I think it's unlikely that the next policy rate move will be a hike. I do think it's clear that that policy is restrictive, and we believe over time it will be sufficiently restrictive. I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope. See if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. We just don't go down that road. If you go down that road, where do you stop?
Nina, that you could make the argument, I think, that maybe there's a bit of a disconnect from what we hear from the Fed chair versus some of the other colleagues on the FOMC. Is this a Fed chair, at least, that has an easing bias? As in, if the jobs picture in the US becomes more concerning, they're more likely to cut than they are to raise rates in the face of stickier inflation?
I can see why some would make that case, and I think there is, you know, some evidence for that. Also, I think we didn't hear it in the clips just there, but there was several mentions yesterday of how much progress has been made on inflation already, despite the recent stall. So I think, you know, if you dissect the comments, you could find some evidence of that. I think also from the clips we just saw, another bit that sticks out is, you know, how, you know, the election and the wider situation is not a part of their thinking. And, you know, I think it's probably not a part of their direct thinking, but it does inform an important context. I think it's what's become clear is that the Fed's job is being made harder by what's happening on the fiscal side in the US, which, of course, is being driven by wider political events and what's coming later this year.
Before we move on to the ECB and the BOE, because I know you've got views on that as well, in terms of the non-farm payrolls that come out later this week, the job story and how that's evolving and how that links into the Fed's decision-making.
Yeah, the chair did say yesterday that they are not focusing, that they're not targeting wage growth, but they are obviously taking their mandate on the performance of the economy, on the performance of the labor market strongly. And, we have heard that they're going to put, if anything, more emphasis on that. And it's very clear from yesterday that they don't basically want to harm the economy too much. They're not willing to crash the economy to get inflation all the way back down to target. So obviously it is something that they're keeping, that they're probably putting increased importance in the coming meetings. I think, yesterday was a little bit of a stalling pattern. We're probably going to hear more of an economic reassessment after the next meeting, but we did hear that they're very much focusing on that mandate as well.
OK, so you hold your view that a cut comes through towards the end of this year from the Federal Reserve. The ECB and officials there saying June is very likely. Can the ECB and BOE really diverge from this Federal Reserve?
They can diverge to some extent, not to a great extent. So we are now expecting that both the ECB and the Bank of England will cut before the Fed does. We heard yesterday in Powell's statement, and he's right to point this out, that there is less room to wait in the Eurozone, in the UK, because of a much weaker growth outlook. And he's absolutely right to point that out. That inflation dynamics are different. The energy shock is working itself out. That was always less of a factor in the US. So the inflation picture is different across the Atlantic, and the growth outlook is much weaker, which really gives the central banks, less of a luxury of waiting to see what inflation does over a slightly longer term. Now, they can't diverge too much. And I think they might be keeping in mind what the Fed is doing, the policymakers in Europe and the UK, that is more so than they let on. So, we've heard statements. In Europe, we've heard varying statements. Some have said that there are more important considerations in mind. We've even heard some central bankers say if the US is holding rates higher for longer, that's actually a reason to cut, because it's going to sort of create a lower growth environment globally. So we've heard slightly mixed messaging. I would still expect cuts to come in from the ECB before the Fed, but there can be too much divergence down the line. So on the back of that, we are expecting fewer cuts from the ECB rest of the year than we have. And I think the UK especially might be reluctant to diverge too much from other major central banks, keeping in mind still the recent history of all the criticism and still sort of the ongoing attention around the delayed hikes that were coming in 2022.
OK, Nina Skero with the analysis, CEO of the Centre for Economics and Business Research. Thank you very much indeed. Now, China's top climate chief says Western decoupling from Beijing could cost the world trillions of dollars and impact the energy transition. Liu Junmin spoke exclusively with our chief North Asia correspondent, Stephen Engel. Take a listen.
If the Western countries continue to insist to decouple from the imports of the China products for clean energy, it will cost the world for maybe additional $6 trillion. It means a 20% increase of the overall cost. We need to maintain the low cost. Otherwise, nobody's going to afford for this energy transition process.
And officials in the U.S. and Europe claim that China is giving unfair subsidies, and that has led to the situation we're in right now that could distort global trade in these clean products. How do you respond?
I think if both U.S. colleagues, European colleagues, going to talk with our Chinese enterprise, you can see all these renewable energy equipment technology, they are innovated and developed and manufactured by our private companies. This is very unique, very unique. I think private companies normally, they don't receive any government subsidies. I think we should really highly appreciate the dedication and contribution by these enterprises. So after more than a decade of their hard efforts, now we have cheaper both solar and wind products, which were now affordable to start the energy transition. I think that this is good for both for China and both for the world.
While we're talking about overcapacity, we have to also talk about the domestic economy here, because we've been seeing profitability sink at a lot of these solar companies and EV companies. Price wars are driving down their margins. What does that do to the climate fight? If the world is bifurcated on trade,
we can talk about capacity in two different ways. For the global demand, as well as China domestic demand, we're still on high demand for the renewable energy products. Because for the Chinese government, I think we're determined to increase our renewable energy capacity to a high percentage, maybe over 80%. I think for the next decade, we're still in the process of increasing our renewable energy capacity. Globally, I think that's much slower than what the Chinese were doing. So there'll be high demand for the renewable energy. For the so-called overcapacity among the manufacturers, among our Chinese manufacturers, it's a temporary issue. It'll be also good that it be through this kind of competition, they can continue to improve their manufacturing and make much more better products.
OK, that was China's special envoy for climate change, speaking exclusively with Bloomberg's Stephen Engel. Plenty more coming up. This is Bloomberg.
The whole game plan is basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. No hint whatsoever of a rate hike.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman.
I think Jay Powell was particularly disciplined here. I think he stayed on message very well. There's a clear bias towards easing, and he stuck to that.
They've left wide open the question of why has progress been less than they expected on the inflation front.
The Federal Reserve is not living up to the commitment on inflation that other central banks are.
Let that tight policy work for longer. I think that's about as far as they're ready to go today. That's hawkish in May. We'll see what hawkish might look like in June.
This is really good for the markets because here's a Fed that's telling us, look at the longer term. Look where inflation was and look where we've gotten it to. Don't worry about the last couple of months. We'll see what happens there.
Some of our guests there reacting, of course, to the latest Fed decision and Jay Powell's comments. Plenty more earnings interviews, by the way, coming up this morning, including a conversation with the CEO of shipping giant Maersk and the CFO of Novo Nordisk. Stay with us. This is Bloomberg.